presume you live in an average middle-class neighborhood in this country, and your neighbor put their home on the market for $1 million. You're kind of chuckling a little bit, but you really hope they get it, because then that has consequences for the value of your home. But you know probably there's not value there in that it's way overpriced. Consequently, if your neighbor then you live in an average middle-class neighborhood and they put their home on the market for $20,000, presuming the house is structurally sound, regardless of your financial situation, you're going to go buy it because you know there's value to be had, that it's worth more. So at the end of the day, when you're evaluating investments, you've got to consider what's the price I'm paying for this given investment. And markets aren't always rational when it comes to pricing investments, so you have to take that into consideration.
You see a lot of people jump in when everybody's jumped in already and the markets are rallying. And so the real risk is that you're going to get whipsawed. And so you're going to get in at the top of the market because you emotionally think, oh, this is a great time to invest. But unless you look inherently at the real value, the fundamental value of the markets, then you're not going to, you may be paying way too much for something that you shouldn't be, and eventually it will correct.
Investing is one of the most counterintuitive things. It's the only area that I know that people run when there are sales and when things are on sale. Usually folks want to buy things when they're on sale, so it seems to be human nature for folks to want to invest in markets or areas or opportunities that are overvalued, that have run up in value, that are getting all the press, that everybody thinks are the hot area. So being a good investor, being a good investment firm, we've got to be able to kind of go against that in some fashion and avoid the emotion of buying into the things that are hot or overvalued or popular right now and look for the things that are undervalued.
Investing is a very emotional thing, and so that can drive investors into eagerness for gain or fear of loss, which creates bubbles and crashes in the world.
That's one of the things that we're really concerned about for our clients, is when people are discontented, they make decisions that often aren't in their best interest. They're chasing something that just did well, and that's usually buying it high, and they end up selling something that's usually low. And that's just the opposite of how you make money in investment markets.
Something can look wonderful, but then you have to ask the price. So we could have a great economy, a flourishing economy, an economy that respects human productivity, that respects capital formation, and yet it's very evident and obvious, and it's priced extremely high.